All right, let's jump right into the latest earnings from the beer giant Anheuser-Busch InBev. Now, this was a really interesting quarter because even with some good news, the market actually sent the stock down. So, what is going on here? Let's get into it. Right off the bat, you can see the core problem. It's a classic mixed bag. On one hand, you've got profit, the earnings per share, or EPS, coming in at 99 cents. That's a beat, which is great. But then you look at the other side, revenue, and it missed expectations by about $90 million. This split decision, this conflict between profit and sales, is exactly what made investors a little nervous. So before we get to the negatives, let's talk about the bull case, which is all about playing some really strong defense. Management was incredibly disciplined, they protected their profits, and, this is a big one, they decided to give a whole lot of cash back to shareholders. Their core profitability, something we call EBITDA, actually grew by 3.3%. Now, what's so impressive about that? Well, they managed to grow profits even while selling less beer. So how'd they pull that off? It really came down to smart pricing and just being super efficient with their operations, which was enough to offset those weaker sales. And this really shows you how good they are at managing the business. Their profit margins got wider by 85 basis points, which is just fancy finance speak for almost a full percentage point. It's a huge sign that they can squeeze out profits even when the sales environment gets tough. The CEO, Michel Doukeris, talked about this continued top and bottom line growth. But then he dropped the real bombshell, a brand new $6 billion buyback program and an interim dividend. Honestly, this was the big positive surprise nobody saw coming. And when you dig into the details, it's pretty powerful. The main event is that $6 billion share buyback. Just to give you some perspective, the market was maybe expecting $2 billion, so this is huge. They also announced their first dividend since 2019, and they're paying down $2 billion in debt. When you put all that together, management is sending a really loud signal here. They're saying, we have a ton of cash, and we think our own stock is the best place to put it. Okay, so strong profits, a monster buyback, why on earth did the stock fall? Well, that brings us to the bear case. It's all about a struggling offense. These are the headwinds that just kind of overshadowed all the good financial news. And here it is. This is the heart of the problem. Total volumes, the amount of stuff they sold, fell by 3.7%. And beer specifically, that was down almost 4%. At the end of the day, a beverage company needs to sell more drinks, not fewer. And this fundamental weakness is what spooked investors. So where did this weakness come from? It was mainly two big markets that dragged them down. In China, revenue just cratered, down over 15%. They're getting hit by a weaker economy over there and some other shifts. And then in Brazil, volumes dropped almost 8%, which the company said was mostly due to some unseasonably bad weather. So that's the problem. But what's the solution? Let's shift gears and look at management's playbook for how they plan to get that offense back on the field and start growing again. They're really focusing on three key drivers. First, premiumization, getting people to buy more expensive beers. And Michelob Ultra is the poster child for this. It's now the #1 beer brand in the entire US by volume. That's a massive win. Second, expanding into new categories. Their no-alcohol beer business is absolutely on fire, with revenue up 27%. And third, their digital side. Their B2B marketplace, Bees, is scaling like crazy. It hit $935 million in value, which is a 66% jump from last year. All right, time to put all the pieces together. Let's weigh the good against the bad, the bull case versus the bear case, and figure out what this all means for the stock going forward. So, the big question for any investor looking at this stock really boils down to this. Do those powerful defensive strengths, the profit margins, the massive cash flow, that huge buyback, do they outweigh the very real offensive struggles they're having with sales volumes in key parts of the world? Here's our take. We think that pressure on sales volumes is going to continue for at least another quarter, but their excellent management should keep profit margins looking pretty stable. This kind of puts the stock in a holding pattern. That massive buyback acts as a floor. It should keep the stock from falling too much further. But without real growth, there's not a clear reason for it to go much higher either. The bottom line is, until we see a real turnaround in places like China and Latin America, the stock's probably just going to trade sideways. Which brings us to our final rating for Anheuser-Busch InBev, Market Perform. So you've got a company with a rock-solid defense, but an offense that really needs to get some points on the board. It's going to be fascinating to see if their growth playbook can actually turn the tide in the next few quarters. As always, this is not financial advice.